This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, Chief Investment Officer at PWL Capital, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
Welcome to episode 338.
All right, so today we welcome Peter Mladina for a very interesting and practical, but also theoretical conversation about asset allocation and factor models. Peter is the Executive Director of Portfolio Research for Northern Trust Wealth Management. So in his job there, he's responsible for the application of research to the wealth management investment process. And that includes research tools and methods that support asset allocation, which is basically what we talked about in our conversation. Now, his research is published in journals. He's got a ton of papers in the Journal of Portfolio Management, Journal of Wealth Management, Journal of Investing. So he's doing research that is getting published, and then he's also applying that in his professional capacity with Northern Trust, which is pretty cool. And he also developed a goals-based asset allocation software that he alluded to during the conversation, which is also pretty cool. It's not available online, unfortunately, but still he's able to speak to how it was constructed and how it works and why it matters to do things the way that he does, that they do. Peter's also a professor of practice at UCLA, where he teaches applied financial economics. I think that's it. He's got a BA in economics from UCLA and an MBA from Edinburgh Business School in the UK. As I mentioned at the beginning of the conversation, became familiar with Peter because he's got a paper on real estate investment trusts where he does a factor decomposition to show that REITs are basically just small cap value stocks and corporate bonds effectively.
Yep.
And I remember reading that paper many years ago and thinking like, wow, that's a 2018 paper. And I probably read it before, I probably read it before it was published in the journal. I'm not sure, or maybe when it was, but either way, it's a long time ago. And so I've kind of followed his research since then. More recently, he's done a bunch of writing on ICAPM and how to apply that practically, which of course is something we've talked about quite a bit on the podcast, more on the theoretical side. So his attempts to make it more practical, I found pretty interesting. And so that's basically what we talked about. But I thought it was a pretty cool conversation. What do you think, Mark?
Yeah, no, it was great. I think the ICAPM stuff, like a lot of that is really just good, like financial planning, right? A lot of it is about kind of matching goals and liabilities with cash flows. And that's a large part of what we try to do for clients at the end of the day. So we're talking about ICAPM, we're talking about kind of portfolio theory from that perspective, but really it's portfolio theory combined with individual financial planning. And so for me, that was very, very fascinating, but the whole conversation was great. He's obviously brilliant. He's done a lot of work across a couple really interesting areas. And so it was a great conversation. I learned a ton.
I like that he's really focused on the practical side of things, and he's working in wealth management. Like he's working quite literally to help people practically implement these ideas. I find that to be pretty compelling, just about his overall story. He's done a couple of really interesting, more recent papers on what he calls joint tests of factor models and manager performance. So he's basically taking market efficiency as the benchmark. So what outcome would we expect if markets were efficient? And then he's testing different factor models on live equity and fixed income and multi-asset portfolios. So instead of it being a more academic exercise, he's looking at actual traded portfolios. And I won't give away the result there, but his findings are super interesting. And I don't know, make you think about just the whole idea of factor investing. And we do talk to him about that in the context of his research results. But anyway, that's probably enough for an introduction. Anything else you would add?
No. Otherwise, we'll spoil too much of it. So I think that's good.
All right, let's go ahead to our episode with Peter Mladina. Peter Mladina, welcome to the Rational Reminder Podcast.
Hi, Ben. Thanks for having me.
Very excited to be talking to you. I read your paper on REITs many, many years ago, which we're going to talk about later, but I've been familiar with your work since then.
Cool. It's funny how some of the papers I like the least are the ones that everyone else likes the most.
Okay, we'll come back to that later. Okay, so to start off, can you talk about the theoretical and practical shortcomings of Markowitz modern portfolio theory?
Yeah, so, and that's in the context of what I believe strongly is a much better approach to asset allocation than what most practitioners are utilizing as sort of the workhorse method. The main shortcomings are, just stepping back, there's three at the highest level. The first is Markowitz MPT is an asset-only framework. How is it that the optimal asset allocation solution doesn't even consider the funding objective? Like what you were trying to do with those portfolio assets. So that's shortcoming number one. Shortcoming number two is that it's a single period model. It's optimal for one period, whatever that period you're optimizing around is. In most cases in practice, that's a 1 year period, because we're optimizing around 1 year capital market assumptions, arithmetic means, which are technically 1 year returns. And then the third would be, there is no kind of sound theory or good theory for constraints. And in practice, we know MPT optimizations are highly sensitive to inputs. And so as a practical matter, you're forced to kind of impose some constraints, which is fine. All optimizations require constraints. However, the truth is, due to that input sensitivity, what ultimately happens is whatever your constraints are going to ultimately drive your asset allocation, which fundamentally overrides the theory of MPT.
And how far does the CAPM go in resolving the shortcomings of modern portfolio theory?
So the CAPM or the ICAPM?
CAPM.
So the CAPM still suffers from some of the shortcomings of MPT, not all of them, but then adds some additional shortcomings. So it's still an asset-only framework, the optimal CAPM portfolio. And we have to sort of differentiate the CAPM as a portfolio theory versus the CAPM as sort of a theory of pricing assets, like a factor model. So here we're talking about portfolio theory. That is one cool thing about the CAPM. It is both, it sort of unifies asset pricing and portfolio theory, so factor models and asset allocation. But to answer your question, it's still an asset-only framework. So that's one shortcoming with the CAPM. It's still a single period model. So that's a shortcoming with the CAPM. You don't have the same issues with theories of constraints, because you're assuming the optimal risky portfolio is the market portfolio. So that's an improvement. But you have other problems. You have, at the portfolio level, you have issues of cash aversion, where most investors don't want to actually have high allocations to cash as sort of their safe asset in a multi-asset portfolio. And then we also know empirically there's at least more than one risk factor, more than just a market factor that explains asset returns. I mean, the literature is full of them. I'm sure we're going to get to a number of them later today. But at a minimum, we know for sure there's at least a market factor for equity and equity-like assets, and a term factor for high-grade bonds that are very different based on any empirical test you can run. So those are so solves one shortcoming, adds maybe two more.
Yeah, okay. So you mentioned ICAPM. How does an ICAPM resolve the shortcomings of the CAPM?
Right. So in the case of the ICAPM, you have improvements over both MPT and the CAPM, in the sense that now we're going to identify a funding objective, right? Maybe that funding objective, if you're a pension plan, is a liability, or an insurance company, it's a liability. Maybe if you're a private investor, it's a goal or a series of goals you're trying to fund, like lifetime consumption or gifting. But whatever we're doing, we're going to basically look at the purpose of the assets in the portfolio. Like in our view here, or I believe anyway, and here at my employer, Northern Trust, we believe essentially assets should have a purpose, right? They should serve a purpose. And that purpose is to fund something ultimately, whether it be a liability or a series of goals. So we can step back and say, we have now a funding objective. Let's construct a portfolio around that funding objective. And the optimal asset allocation solution is no longer an asset-only return versus risk perspective. It still incorporates elements of return and risk, but now in a way we're going to optimize it so that, in the most optimal way possible, we are meeting the funding objective. So the improvement or the enhancement of the ICAPM over both MPT and the CAPM is essentially now it is an asset goal or asset liability framework, a liability relative or goal relative framework, not an asset only framework. So that's enhancement number one. So in terms of doing that, now we've turned it from a single period model, say, optimal for 1 year or 1 month or whatever may be the case, and we've turned it into what we call an intertemporal or multi-year model, where it's going to be optimal over the full period, whether that's the next 10 years, the next lifetime, the next 100 years, whatever might be the case. And so in so doing, we've added or incorporated a set of liabilities or goals. They have the character of time associated with them because liabilities and goals exist through time. We're going to create an optimal portfolio around those liabilities and goals that exist through time. And so we've moved from a single period model to a multi-period model. And thirdly, we had the problem in MPT of no good theory for constraints, but with the ICAPM, like the CAPM, we can rely on kind of market efficiency, at least as a benchmark, to help us see what the optimal risky asset solution ought to be in the portfolio. So at least we can either use that and take that portfolio as the optimal risky asset / optimal return seeking portfolio, or we can use it at least as a benchmark to set constraints. So now we have a good theory for constraints and determining what that portfolio should be. So at the end of the day, you have two kind of sub portfolios, kind of this liability hedging or goal hedging portfolio and this return seeking risky asset portfolio. And you combine you construct the two in a way that's efficient relative to funding your liability or goal profile. And then you will basically select the allocation to each based on, funded status and risk tolerance. That does away with the other shortcoming of the CAPM where, investors have potentially, aversion to high allocations to cash in the portfolio because we've redefined the risk-free asset. Right. It's no longer, the safe asset is no longer cash, but rather some sort of, high-grade bond portfolio that's, very closely cash flow aligned with the liability profile. So in that way, in a number of different ways, we've actually significantly mitigated the issues with MPT and the issues with the CAPM by moving to the ICAPM.
Mm-hmm. Okay, so you already touched on this, but maybe we can elaborate a little bit more. So how is the optimal ICAPM portfolio for a given investor different from the optimal CAPM portfolio?
Yeah, so let's start on, again, like you're right, I touched on it, but now's a great time to go into more detail. Like, let's start with our definition of risk and what the risk-free asset ought to be, right? So in the CAPM, the definition of risk is some concept of kind of volatility or low volatility. So that's why the risk-free asset in the CAPM is cash or treasury bills, right? That's commonly viewed as a safe asset because it has the least, or it has, arguably no volatility to it, right? But in the ICAPM, that's not really the relevant definition of risk. The relevant definition of risk is a liability relative or a goal relative definition of risk, because ultimately the risk that matters is the risk around funding that final liability or that final goal profile. The risk that ultimately matters is the dispersion in final funding outcomes, right? Mm-hmm. Is there significant dispersion to future surplus or shortfall in funding outcomes? So the first most important thing is to redefine risk from this asset-only view of volatility to this liability relative risk about that really ultimately manifests as dispersion in future funding outcomes. With higher dispersion in future funding outcomes, you're more likely to fail in terms of funding that liability. And so, you can think of it that way, but another way to think about it is, what's that definition of risk? It's a different definition than standard deviation. It's something, it's actually better characterized as tracking error. So we've changed our definition of risk from asset only to liability relative by moving from standard deviation to tracking error as our definition of risk. And it's tracking error relative to funding that liability or goal profile. So what asset is risk-free in relation to funding that liability profile? Well, the asset that has no default risk and is perfectly cash flow matched with the cash flows of that liability or goal profile is your risk-free asset. So let's step back and think about it. Let's say you had a liability due in 10 years for $1 million. The asset that's risk-free relative to funding that asset might be a zero coupon 10-year treasury bond. Has no default risk, at least in theory, has no default risk, and will perfectly mature at $1 million 10 years from now, right? There's no dispersion in future funding outcomes around using that asset. It may have a lot of volatility between now and the next 10 years, right? But 10 years from now, it's going to mature at precisely $1 million and fund your liability without any risk. So very different perspectives of risk. Cash would be your definition of risk if you have an asset-only view, but if you're trying to fund $1 million 10 years from now, that zero coupon 10-year treasury bond is your definition of risk. So therefore, we want to create kind of a liability hedging risk-free asset from that perspective. One that has essentially no default risk and is perfectly cash flow matched. Now, in practice, there may be very many reasons where something like that is kind of impractical. Not all maturities may be a valid. Most liability profiles are more complex than sort of a single bullet 10 years out. You can have the reality may be that not all bond maturities may be available to meet your liability or goal profile. Additionally, most bonds pay coupons, so there's reinvestment risk. There could be other practical reasons to use different types of bonds than just treasury bonds. So you can get very close to the risk-free asset in practice by using something we'll call a liability hedge instead of the true risk-free asset. So as long as you're using high-grade bonds that have very minimal default risk, and you're aligning those bonds in a way where you're at least on average duration matched, you can get very, very close to a intertemporal risk-free asset by essentially minimizing the tracking error relative to liability using high-grade bonds with minimal default risk and duration matching those bonds on average with the duration of the liability or the growth profile. So a couple of things so far, just to recap. Most importantly, with the ICAPM, we have to redefine risk to be liability or goal relative. And then we have to redefine the risk-free asset to be the asset that funds that goal or liability profile with the least amount of risk. And that's not cash. Okay. And then now we have to look at, once we've defined that portfolio, that liability hedging portfolio, that optimal liability hedging portfolio, now we can look at the rest of the portfolio and say, okay, there may be some component that I still want to bear risk around. And what is that portfolio? What's the optimal return-seeking portfolio of risky assets? And we can still optimize that portfolio relative to the liability. Now, if you're a big believer that markets are efficient, right, you essentially can take the market portfolio of risky assets to be your return-seeking portfolio in the ICAPM. However, if you choose to deviate from that market portfolio of risky assets, you can at least look to it as a benchmark to set constraints in your own optimization procedure. So you may choose to deviate because you have a different worldview about expected return and risk than maybe you see in the market portfolio of risky assets. You may deviate because you pay taxes. You may deviate for many reasons. Maybe you have other outside assets to consider, human capital, other major concentrated positions. So there could be a number of reasons you choose to deviate, but you can still use that market portfolio of risky assets to set constraints and run an optimization procedure that gives you essentially the optimal portfolio of risky assets. And so at the end of the day, you have this, this optimal liability hedging portfolio, and you also have this optimal return-seeking risky asset portfolio. And depending upon, both your risk preferences and your funded status, frankly, you can choose, what proportion of each to align with a liability or a set of goals, whether, they're higher priority or lower priority.
Okay. So walk me through practically, like I've got a client who wants to retire in 20 years. How do you allocate between the liability hedge asset and the risky assets?
Right. So it's a great question. And, there are different ways to do it, but, just getting to the core methodology of the ICAPM. What's great about it is it's a process that works both with, kind of pension plans with, singular, singular homogeneous liability. And it works just as well with a private investor who has a series of kind of heterogeneous goals that have different priority levels associated with them. Some goals may be super high priority and therefore the investor wants to take less risk around them. Other goals may be more aspirational, so the investor is willing to take more risk around them. And the nice thing about the ICAPM is that you can have full hedges, you can have partial hedges, and you can have no hedges. You can fund a goal, an aspirational goal, for example, without any allocation to the goal hedging portfolio. So you can really impose your level of risk preference. So again, what you would do is, you would go through a discovery process with that investor and you'd identify and value all of their goals. And you would understand them. So, you gave the example of, their retirement, like, their lifetime consumption and retirement. Clearly that's one goal. It might be broken down into different phases. Phase one, while they're still very active, traveling, doing many things. Phase two, while, they're much older or more sedentary, there may be, healthcare issues to also consider. So you can break down, goals in more granular ways. You can think about gifting goals, gifts to generation 2, generation 3. You can think about gifts to your alma mater. There's all sorts of goals at the end of the day. There's a number of different ones. But at the end of the day, we're going to want to go through that process of understanding and quantifying those goals, valuing them. And that's a process of also understanding the priority level for each goal. Higher priority goals will get higher goal hedge allocations. Lower priority, more aspirational goals will generally get lower goal hedge allocations or no goal hedge allocation. Perhaps they're funded completely by the return-seeking risky asset portfolio. So, goal by goal, we can go through and understand risk preferences around them. And then at the same time, as you understand these risk preferences, we have an additional good piece of information that helps with portfolio selection, because it can give you essentially your funded status, both at the goal by goal level and in the aggregate portfolio level. We can have, depending on the assets you have and the risk you're willing to take around the goals that you're trying to fund, we have, you still at the end of the day have budget constraints. And so you can think about, how much risk I, may prefer to take, or maybe how much I may need to take to fund my entire profile of goals. So there's very much a back and forth and a set of trade-offs. And as you move through the course of your life, this process is also very adaptive, and that's very important. As expected returns become realized returns, funded status may change, and you can make adaptive trade-offs and revisit the degree to which you hedge each goal. Obviously, if you completely hedge each goal, you can go away and sleep at night. You never have to make adaptive trade-offs. But the degree to which some or all goals are funded, at least in part, by the return-seeking risky asset portfolio, there's still risk around funding those goals. So adaptive trade-offs over the course of your life are still important. So at the end of the day, practically speaking, goal discovery. With each goal, we're going to identify how much of a hedge you want to impose, anywhere from 100% to fully secure those goals and never have to worry about them again, to 0%. And, for an aspirational goal, evaluate funded status and, revisit as we move through the course of your life, because you still are incurring risk to some degree in most cases to fund those goals, unless you've completely hedged away everything.
So, and do you think that's sensible for individual investors to try to fully hedge those consumption liabilities?
I don't see it in practice. I mean, especially, kind of for, your typical, so where you see investors fully hedging away their consumption liability is sort of, high net worth, ultra high net worth investors who have so much surplus assets that, oftentimes they may choose to hedge away, all of their goals, and then surplus assets are the ones that are just held in the risky asset portfolio. So that's where we see it more commonly. But even in those cases, typically there may be some element of a partial hedge, even though, it's largely hedged away. For many other investors, the mass affluent and, normal retirement savers, that's where I get back to, you may be forced to take risk to fund your retirement goals. Just be aware of the risk you're taking, how much of the goal you're hedging away and securing essentially, and the degree to which you may have to make adaptive trade-offs over the course of your life as expected return becomes realized returns. Maybe you'll get lucky and get better returns than you expected on the risky asset side. Maybe you'll be unlucky and you have to revisit your goals and modify them. So, there's value in adaptive approach. But again, the degree to which you can hedge away your goals, you don't ever have to worry about them away. You don't have to worry about them again, as long as you properly construct that goal hedge to have minimal default risk and to be duration matched on average.
What role does Monte Carlo simulation play in building ICAPM portfolios?
Yeah, you can. So getting back to portfolio selection, I talked about, you can walk through each goal. You can, identify how important each goal is to you. Is it high priority and therefore you want to take less risk around it? Is it low priority, you want to take less, maybe you're willing to take more risk around it because it's aspirational. And then I said fund status, deterministically is a way to evaluate whether or not, hey, maybe I need to take more risk around some goals because I'm underfunded unless I do. Or alternatively, like I said earlier, maybe I'm so overfunded, I have so much surplus assets that, I can hedge away more and more of my goals, right? And we see that more with kind of the ultra high net worth space. But that's a deterministic view of funded status. And the real world is stochastic, right? Or is better represented by stochastic and Monte Carlo simulation. And so in addition to that stochastic view that helps with portfolio selection, helps with understanding funded status. We can use Monte Carlo simulation to inject risk, not so much on, there really is no risk or minimal risk on the liability hedging side. All of the risk is on the return-seeking risky asset portfolio. We're able to build Monte Carlo simulations that capture that dynamic in a complete way. So they're different than the traditional kind of MPT Monte Carlo in the sense that these ICAPM Monte Carlos capture the de minimis risk of the liability hedging portfolio and then the excess of goal risk of the risky asset portfolio. And we bring it all into the present. So that's two main differentiators, is that the risk here is risk in relation to funding the liability or goal profile, and the Monte Carlo is built that way. Your risk is tracking error, not standard deviation in this Monte Carlo. And then additionally, we bring it's not a Monte Carlo into the future, but rather a Monte Carlo that brings you to the present to augment or supplement your deterministic view of funded status. We're able to evaluate funded status stochastically via the Monte Carlo, so you can see the risk around your current funded status and the degree to which in today's dollars you have a shortfall or a surplus across the distribution of potential outcomes. We think of present value Monte Carlo is far more meaningful because most investors intuitively understand dollars they have today in terms of surplus or shortfall in terms of decision making. It's much more intuitive than thinking about dollars I might have 30 or 40 years from now.
Right.
Yeah, no, that makes sense. And how does human capital fit into ICAPM portfolio construction?
Right. And I think that, so human capital, particularly as we apply the ICAPM to goals-based investing, is really important. At the end of the day, most private investors have a lot of different potential assets that can fund their goals, right? Their lifetime goals or consumption goals, retirement, gifting goals, et cetera. And we most commonly think about in our business, their portfolio assets, their financial assets, but they may have many other assets they can use from, personal property they might have, personal assets they may have, but also most importantly with most investors, human capital, right? So the present value of future labor income. And at the end of the day, human capital is an asset and we can even capitalize it. I mean, there are other complexities around it, but we can take the value of that future labor income, bring it into the present value it, and we can look at it as an asset, just like we look at portfolio assets to help fund goals, right? And so, in an ICAPM framework, we can do it in a number of different ways. But fundamentally, at the end of the day, what we're doing in a goals-based application of an ICAPM is incorporating that asset as sort of this outside asset that funds goals, so that really the portfolio of financial assets sits right next to that portfolio of human capital assets, and both are there and enable you to fund goals. Now, it adds some complexity because there are things you have to think about. Just like we align an ICAPM portfolio, the liability hedging assets and the return-seeking risky assets with the cash flows of the goals that a client or that an investor may have, we need to do the same thing with human capital. We need to align it so that human capital funds, an investor's goals as they move through time. And this adds complexity when we have a bunch of different types of assets, portfolio assets, financial assets, and human capital assets. They need to work together and need to look at the sequencing and mix of assets and how they're funding goals, right? Different assets, how do they mix together, and how are they sequenced in terms of funding goals? So if you think about it for a second, oftentimes investors have future human capital, they save it, it goes into an investment portfolio, and then it eventually funds goals. So that's a sequence of discount rates you need to think about. Alternatively, you may have, a mix of portfolio assets and human capital assets that kind of contemporaneously fund a goal flow together. So I won't get into the technical details, but the bottom line is it's just another asset to consider that sits next to your portfolio of financial assets. And, ideally you'll capitalize it like you do. It brings it to the present. So you can think about it right next to your portfolio of financial assets in terms of how it funds goals in the future. The challenge is what is the risk of human capital? So what's the appropriate discount rate? And the complexities of sequencing it relative to all the various goal flows that compose a profile of goals or a liability, or the profile of cash flows that compose the liability. So it adds some complexity, which is why a lot of people don't actually do it. But it's really important to actually solving the optimal solution for private investors.
So I'll be honest, I've read your papers on this. I've read John Cochran's most recent paper on this, and we're not using ICAPM in practice with clients at the moment at our firm. And I don't think many practitioners are. What steps do you think practitioners should be taking to start using ICAPM in the advice they give to their clients?
Right. Well, kudos to you for reading the papers and understanding the concepts. And you mentioned John Cochran. I know he's been a guest on your podcast. I mean, a lot of my work, I'm a practitioner first and foremost. I also teach, but it's more of a side job. And a lot of this research has relied on some of the original research of John Cochran, and I need to give him credit first and foremost. I think a lot of my contribution is kind of bringing it to life in the practitioner world, kind of working out, how do you take this theory? Is it valid empirically? And then how does it work in practice? So you ask a great question. I think firstly, read the papers, right? An ICAPM framework for asset allocation, the Journal of Portfolio Management, an ICAPM for goals-based investing in the Journal of Wealth Management. Empirically forthcoming, I have compensated portfolio risk or the compensated risk of multi-asset portfolios forthcoming in the Journal of Portfolio Management. I think if you understand those frameworks and that concept and how it links back to the papers of Cochrane and others and the seminal research done before them, I think you'll have a really sound anchoring in the theory and frankly, the empirical evidence as to why this is a superior approach to asset allocation. Now, how do you bring it to fruition, right? The first thing I think is to start thinking about, risk from a goal relative or a liability relative perspective and start to kind of move away from standard deviation as your definition of risk. Start working with clients and explaining risk from that perspective and what might be a set of assets that really is their safe asset. It's not cash. It's going to be something that is, again, safe relative to funding their goal profile, right? So in practice, something that is composed of high-grade bonds, that's duration matched on average. In theory, something with no default risk, perfectly cash flow matched with the cash flows of your liability or goals. From there, all other assets are available to create that return-seeking risky asset portfolio, right? It could be other types of low-grade bonds. High-yield bonds can be part of that return-seeking risky asset portfolio. But more commonly, equity and equity-like assets, private investments, et cetera, can all be part of that return-seeking risk asset portfolio. So thinking in terms of these two sub-portfolios, right? That safe liability hedging or goal hedging portfolio and that return-seeking risky asset portfolio. As a practitioner, how do I build each? Well, we already talked about how we can build the return-seeking risky asset, the liability hedging portfolio or the goal hedging portfolio. Next, let's talk about how do we build that return-seeking risky asset portfolio? Well, if you're a big believer in market efficiency, it's very easy. Just take a look at the, of all risky asset classes out there, which is pretty much every asset class minus liability hedging assets. What is the cap-weighted market value of all of those things? What's the relative cap-weighted market value of all of those? Well, that's the market portfolio of risky assets. So if you're a big believer in market efficiency, stop, you're done. That can be your risky asset portfolio. If not, like I said, there's an optimization process that we document in the paper where, we can, for various reasons, maybe you have a unique liability profile, every investor does. So maybe your optimal return-seeking portfolio is a little different than the next person because of your liability profile. That's an important consideration. But there could be other reasons, like I said earlier. Maybe you have you're an active investor and you have a strong point of view of expected return and risk. So you want to deviate from that market portfolio. You can optimize around that. Or, additionally, you may have other real world constraints like you pay taxes or you have outside assets that are a significant portion that you can't really do much about it. And so you'll want to work around that. I do think that creating software around this and having an interactive approach with a client is really optimal. That's something we do here at Northern Trust. And, and I have had many RIAs, advisors reach out to me to see if we were willing to license this software. From what I understand, out there today, there really isn't something. There are goals-based approaches, but not one that's really, really well anchored to the ICAPM like we do here at my firm. But I do think a software-based approach also helps a lot because I think it helps with that goal discovery process and working through the implications of, identifying goal hedges per goal right? Do I want to hedge away 50%, 75%, 100% of each of those goals? And then what are the implications in real time? And then how do I make adaptive trade-offs? So I do think there's value in having a software application kind of do this real time with an investor as well.
That makes
when
sense.
we turn it to practice.
How important is it for the liability hedge asset to be like a real return asset, like TIPS in the US? And I asked the question because in Canada, we don't really have a real return bond market. The government has phased that program, or is in the process of phasing that program out. And it's just not that popular of an asset class for Canadians because of the structure of the market.
Yeah, so that's a great question. So the first thing I would say is your liability or goal nominal or real? Right? Is it inflation sensitive or not? So if you're in the world of, at least in the US, if you're in the world of pension plans, particularly corporate pension plans, like those are actually typically nominal liabilities. So you would want to use nominal bonds because you have a nominal liability you're trying to fund, right? Now you move into the world of private investors, most goals are, well, first of all, we should differentiate between sort of a legal liability like a pension plan has and a goal, which tends to be more discretionary, right?
Right.
As a goal, you have much more flexibility in how you want to fund it. But most goals are, among private investors are in fact real goals, right? They are inflation sensitive. So an optimal solution in the US anyway would use treasury inflation protected bonds primarily. Now it's interesting because in private wealth, investors are allergic to paying taxes. So in the US in particular, there's a very strong preference for municipal bonds, but municipal bonds are subject to a significant amount of inflation risk.
Right.
At least most implementations of municipal bonds are. And so that's a problem. And behaviorally, there is the challenge in getting, high net worth investors to overcome, at least to some degree, their preference for not paying, the preference for avoiding taxes through municipal bonds by utilizing treasury inflation protected securities. But you're right. The reality is that if you are looking for a true goal hedge that mitigates all goals, not just mismatches of duration risk, so not just undue term risk or default risk, but also inflation risk, you'd want to use inflation protected bonds. Now, you could use derivatives like swaps and things like that if you don't have a market for government inflation protected bonds. So you could use high grade bonds with swaps. You have to do a little bit of portfolio management and engineering to get there. So that's available, I believe, to you guys in Canada. But again, it requires a little bit more construction liability hedge to get there. Now, in practice, again, getting back to the US, where, again, a lot of high net worth investors have a strong preference for municipal bonds. It turns out that you don't necessarily have to have 100% TIPS allocation, because the reality is that even with TIPS, you still, you don't, because of taxes, you don't have a perfect inflation hedge. You only have a partial inflation hedge to the degree of one minus the tax rate. So, so even then, even with TIPS, you don't have a perfect inflation hedge. So that therefore leaves room for municipal bonds in your goal hedge. It just turns out you still need a pretty material allocation to TIPS to kind of craft that optimal goal hedging portfolio. So it tends to be, in the US anyway, a mix of high grade municipal bonds and TIPS that gives you the lowest tracking error relative to funding goal profile, which will give you the least amount of dispersion in future funding outcomes.
If we can go back to a second about a few minutes ago, we were discussing human capital and it's the way it plays into ICAPM. And Ben, you said that not a lot of practitioners are using ICAPM in that way. And I just have a question about, so like with our clients, we combine risk tolerance and then risk capacity when helping to design portfolios. And risk capacity for us is more kind of quantitative, right? And we look at, when we think about human capital, we're thinking of the stability of that human capital over time, things like whether you have disability insurance in place, how risky is that that income stream for the individual in the future. And obviously those who have more stable human capital might have the capacity to take on more portfolio risk. Is that a kind of a light form of implementing ICAPM?
Yeah, that's a light form. I mean, I think anything you can do, and there's more than one way to do this, right? I think anything you can do to incorporate human capital for investors that have large human capital components that are, material relative to their financial assets, I think that's good. And what you kind of identified or summarized there, I think is a good approach. all I'm saying, and I agree, like that notion of risk tolerance and risk capacity, we also use it here at Northern Trust and in our goals-based methodology. And we think about risk tolerance as something that's more psychological, right? Like different investors can have different risk tolerances, and that's something a little bit more psychological. But psychology is important to finding a portfolio that's optimal to an investor and one that they can stick through in good times and bad. But risk capacity is a little bit different. And agree, it's more quantitative. Do you have the capacity to bear risk? And a lot of times that has to do with how much surplus assets you have. So you could have a ton. You could have an ultra high net worth investor with a ton of surplus assets. They could easily fund all of their lifetime goals, regardless of what happens to the market. For example, they have a ton of risk capacity, but maybe they have, so quantitatively or financially have a huge risk capacity to bear risk. But behaviorally or psychologically, they may have low risk tolerance, right? Despite that capacity. So, and then other investors may have very little capacity to bear risk, but have high risk tolerance, right? So the two aren't necessarily highly correlated. And in kind of finding a portfolio that is optimal for an investor, you have to consider both those things. And so the ICAPM does that, in identifying your the degree to which you want to hedge your portfolio is going to partly be based on risk preference, right, or risk tolerance. But then as you look at your funded status, the implications of funded status, both deterministically and stochastically through Monte Carlo, that gets back to risk capacity. And you may have to modify what you had picked in terms of hedging your various goals. You might have picked them, with the concept of risk tolerance in mind, but now you have to go back and modify them based on risk capacity. And all of that, getting back to your question about human capital, is important to incorporate the best you can. But really, the best way ultimately to do this is to treat human capital as if it were any other asset. And any asset is really just the present value of all of its future cash flows. We can bring it back to the present, we can capitalize it, and then we can look at the sequencing of those cash flows, and we can look at our financial assets, our human capital assets, and we can construct an optimal portfolio of financial assets in consideration of the risk around your human capital. And you're right, different human capital has different levels of risk, but still we have to get back to, well, what's the right discount rate? And I don't think that has really been well established. I mean, a lot of the earlier literature has sort of argued that human capital is kind of, bond-like risk and it's safer than your financial asset portfolio. I think that's true if you had a diversified set of human capital, kind of like a diversified set of equities, which you can have in your portfolio. But the reality is that you don't. You can't diversify away your human capital. It's very unique to you as an individual. And so therefore it has a lot of idiosyncratic risk associated with it that, to me makes it, if not equity-like for most people, something more of a hybrid between sort of, a safe asset and a risky asset. Nonetheless, we've figured out ways to incorporate human capital where the discount rate doesn't necessarily matter. I think at best you can say the discount rate is abstract and nebulous, but there are other more technical ways that we can incorporate human capital so the cash flows match up regardless of what the actual discount rate is.
Mark's question made me think of another question. And Cochrane touches on this in his paper on this. If we have an investor who's very averse to dispersion around their goal, and which would then suggest a fully liability hedge portfolio with some kind of probably long-term real return bond, but they're also very averse to volatility. How do you square those two things? Because they've got on one side a preference for cash, which has a wide dispersion of outcomes, and then the other, so you get it. So how do you deal with that?
Right. No, it's a great question because like a lot of things in our business, I think, the best approach is to educate clients or investors on a number of things. It's a constant process of education. And really the first thing here is to educate the investor on the definition of risk that ultimately matters, right? If you have a liability or a goal profile you're trying to fund, the definition of risk that matters is not standard deviation or volatility. It is a goal relative definition of risk. And then you have to walk through what the implications are, right? And that's why I like to use that example of a 10-year treasury, a zero coupon 10-year treasury that's there to fund $1 million 10 years from now. Because I guarantee you that 10-year treasury is going to have some volatility far higher than cash over the next 10 years. but only that 10-year zero coupon bond is going to mature at $1 million 10 years from now and fund that liability cash flow without any risk. So education, understanding that perspective is key, and understanding that there will be some volatility between now and funding your goals. And so what we try to do is provide those illustrations, and we can show that because cash has such huge reinvestment risk, you can show that, that exact example. There's a lot of risk around funding that $1 million liability due 10 years from now if you tried to use a series of cash investments. And it's simply because you don't know what the future yields on cash are going to be. And so therefore there's a huge dispersion in that outcome. So really, I think the answer is to educate the investor on this issue, show illustrations empirically with real world data, and it helps them come around. And frankly, it provides a much better story for your bond portfolio than you might otherwise have had in an asset-only world where the lowest volatility asset is cash, and then so everyone starts thinking about, instead of using high-grade bonds, they start to migrate into lower credit quality, which in a lot of ways isn't the most optimal way to pick up the risk of a return-seeking risky asset portfolio.
Yep.
So education, I think, Ben, is the real answer. And because the truth of the matter is, there's no good way to give them both, right? You can't have a low volatility solution that's also the lowest risk asset relative to funding your goal profile, unless that goal is a year away, in which case, by the way, there is a role for cash. If that goal is within the next 12 months, cash is your optimal goal funding asset.
Yeah, I agree with all that. I think that education around volatility not always being a risk is such a big thing for investors, and I don't think most investors understand it.
Yeah, it's just stepping back, asset-only risk or goal relative risk, right?
Yeah.
Standard deviation or tracking error relative to the goals. And why is tracking error important? It's because tracking error is the definition of risk that manifests through time into dispersion of future funding outcomes, which is the risk that really matters. How certain is it that you are going to successfully fund that goal?
Yeah, that's a great explanation. All right, I want to move on to your papers on factor models, which, as I mentioned earlier, is how I initially discovered you. So to kick off that topic, can you talk about the economic logic behind why common risk factors should explain returns across most asset classes?
I mean, I think at the highest level, the idea is compensated risk. Like what source of kind of systematic risk, right, or risk that is sort of common across assets and portfolio of assets are compensated with return premia that explains sort of the return and risk of these assets and portfolios of assets, right? So like at the highest level, right, what are the systematic risks that explain assets and portfolio and sort of portfolios of assets? I think that's kind of, the highest level notion here. Now, some of these have good sort of theoretical and empirical validity to them. So you can think of like the market factor for equities, right? Which is sort of traditionally defined as the return of equities minus the return of treasury bills. Is there a return premium associated with the return of equities minus the return of treasury bills? Well, it turns out empirically the answer is yes. There's a return premium. Empirically, for many assets and portfolio of assets, sensitivity to this factor seems to explain asset returns, portfolio returns. And so the market factor kind of hits both of those criteria, right? Like there's a good theoretical rationale for it. In a capitalist system, investors are taking on risk to provide capital to finance companies, and they expect compensation for bearing that risk. There's a good theory behind it. And empirically, it seems to come with a return premium and explain some of the common variation in assets and portfolios of assets. Other factors that have been sort of documented in the literature, small, some things like the size factor and the value factor for stocks, for example, they seem to be there empirically, but they don't necessarily have a good theory behind them. So, when you ask about what's sort of the theoretical rationale or justification behind them, I think some of them have good theory and empirical evidence. Others are maybe more empirical risk factors that don't necessarily have a good theory behind them, though, theories have been proposed, but there really isn't a good consensus around a lot of them. But in a nutshell, I'd say like a good factor should have 3 or 4 criteria to define them. First, it should come with a return premium, so it should be a compensated form of risk. So historically, there should be some statistically significant return premium, right? A robust, reliable return premium statistically that you can have some confidence that will, happen going forward, right? So that's number one. Number two, it explains the common return variation, or the systematic risk of assets and portfolios of assets. Number three, a factor should be independent of other potential factors, right? So it's not a redundant source of return and risk. So if you have those 3 together, you have a common risk factor. But I'd add that 4th criterion where, in theory, we want a good, sound theoretical foundation of risk. And why is that important? Because I think with a good theory and strong empirical evidence, it's more likely to persist in the future. If you just have a factor based on empirical evidence without a sound theory, you run the risk of it maybe being the result of data mining rather than something that you can have high confidence is going to persist into the future.
Mm-hmm. And why is it important to look at asset classes through a factor lens?
So that's a great question. And, as we think about, again, it's interesting, and there's still work to be done here that I'm doing and others are doing, but the holy grail in financial economics is to unite portfolio theory with asset pricing. And the CAPM was the first attempt of that. The CAPM is cool because, at least in theory, it's a portfolio theory. How do you build asset allocation, portfolios of asset classes? And it's also a theory of asset pricing. How is a stock priced? And the CAPM, at least in theory, unifies asset price, portfolio theory, asset pricing. We'll call that the holy grail. So there's sort of an analog in physics where, they're trying to unite relativity with quantum mechanics, and they're not quite there yet. And so, stepping back and trying to unite the two, asset classes are sort of in between portfolios and securities. But in practice, most investors commonly take, asset classes as the building blocks to construct portfolios. But we commonly define asset classes in sort of an arbitrary way. There are categorizations of assets that are similar to each other, but ultimately what matters in portfolios and asset allocation is the behaviors of these assets, right? What are the return and risk behaviors of assets? And it turns out that, there are dozens of different asset classes potentially, depending on how you define them, that you could build a portfolio around. But it turns out that there are only a handful of common risk factors that explain the return and risk of all of these asset classes, and thus of portfolios of asset classes. And so it turns out that asset classes underneath them have overlapping exposures to common risk factors. And it's the common risk factors that ultimately matter in constructing portfolios, because they are the drivers of return and risk of assets and securities that ultimately drive and explain your overall asset allocation. So at the end of the day, they're the ultimate driver of asset class returns and thus portfolio returns. Now, we can get into it a little bit later, but it turns out that, at least at the portfolio level, maybe you don't need so many common risk factors to explain, multi-asset class portfolio returns.
Yeah, I do want to get into that in a bit. So there's this zoo of factors, though. As you know, what are the main factors that you're looking at in your research?
So, one thing that, my job at Northern kind of captures kind of at the highest level kind of two things. And actually, I teach at UCLA also, and the course covers kind of both notions of, portfolio theory and asset pricing. And so we talked a lot already about, portfolio theory and how we can take theory, empirical evidence, and practical implementation and construct robust asset allocation portfolios that kind of fund lifetime goals. But the other area where I work, kind of deals with, well, how do we, select investments and think about, the risks and funds, hedge funds, private investments, mutual funds, separately managed accounts, the risk managers take to kind of generate return and the risks that they're bearing in so doing. So a lot of the research we've done is try to understand, as we evaluate the performance of risk of various investment products, to understand what underlying risk factor betas, various strategies are exposed to, the prevalence of alphas, right? Like after solving for the risk investors take, is there any leftover alpha, risk adjusted excess return? Is it random? Is it real? What's the prevalence of those alphas across asset classes? What's the most important risk factors in various asset classes? So it's a very practical reason, we kind of on an ongoing basis evaluate really the entire universe of active managers available to us across asset classes. So we have a very good understanding of kind of across, for various asset classes, what common risk factors are, the genuine common risk factors in traded portfolios. As you kind of hinted at, there's an entire literature on kind of mining factors from the historical data. And commonly you'll see for equities, for example, market factor, size and value. Fama French back in the early 90s kind of published that factor model. That continues to be kind of the workhorse model. More recently, they added kind of profitability and investment factors. Back in the 90s, there was also evidence of momentum factors. So there's this zoo of factors in equity. In fixed income, there's a term factor, default factor, or a credit factor, prepayment risk factors. Other authors have tried to show like momentum and quality factors and other sorts of factors akin to what you find in equity and fixed income. So there seems to be this plethora or zoo of factors, but do we really need so many factors in real world portfolios? Because like I said, a lot of these tests have been done on kind of portfolios using historical data that weren't necessarily live real world traded portfolios. In the world I live in, where we try to evaluate real world investment managers to understand the risks they're bearing and whether or not there's real alpha there, what we've done instead is taken the act of evaluating real world portfolios to try to understand, well, of this zoo of factors in the literature, which ones are genuine common risk factors in real world portfolios? Because what we found in our manager evaluation was not necessarily what you see coming out of the academic space nowadays anyway. And what's the prevalence of alphas? And so what we found, to answer your question, what we found was a couple of interesting insights. On the equity side, first of all, you can improve all factor models by moving to a different definition of the market factor. Like I said earlier in the CAPM, it's the return of equities minus the return of treasury bills. What we did instead was we modified it to be an ICAPM definition. The return of equities minus the return of treasury bonds is a pretty good proxy for an ICAPM definition of the market factor. And it turns out that that definition improved all factor models that we tested. It also turns out that we didn't really need to add any more factors to that factor model. The ICAPM by itself explained away all alphas across the distribution of funds we tested since the early 1970s. Right? So that was an amazing outcome that basically said you didn't need to add size factors, value factors, profitability, momentum to explain away more alphas. So that was interesting. It did turn out that adding size and value helped explain more systematic risks, so more return variation than just the ICAPM market factor, but they didn't actually explain away any more manager alpha when we evaluated real world portfolios. So the best we can say is there in the market, there's really only one genuine market factor that met all four of those criteria that I mentioned earlier, right? Statistically significant premium, explains systematic risk, is not redundant, comes with a good theory. Only the ICAPM market factor met all four of those criteria. Size and value factors also helped explain some systematic risk, but did not explain away alphas. So didn't necessarily come with a reliable return premium. And then we really didn't see any evidence of either, of things like momentum, profitability, investment, either explaining away alphas, so not coming with verifiable return premia in live traded portfolios, or they weren't explaining any systematic risk. So for equities anyway, one genuine common risk factor and an ICAPM market factor. I would say size and value are secondary risk factors. They failed in terms of explaining away alphas, but they helped explain some systematic risk. The other factors, I'll just call them anomalies. They seem to be there in the historical data. We're just not necessarily seeing them manifest as verifiable return premium in real world portfolios. That was a long-winded answer, so I'll stop there. We can go into fixed income, or we can, dig into wherever you want.
Well,
You can unpack that however you want to.
I might want to come back to what you were just talking about with the sort of single factor ICAPM model for explaining returns in traded equity portfolios. I have a couple more questions on that, but I want to pause for a second and come back to the REITs, the real estate paper that you mentioned earlier. Before I start with my questions on that, why is that one of the papers you don't like that much?
Yeah, no, I overstated it. I think that paper, and you might even allude to it, one of my first papers was on kind of replicating the Yale endowment. That was another one, partly because I think subsequent research that isn't cited as much because it's a little less popular was like far better. So I think, so what was cool about real estate betas and the implications for asset allocation, I think that what you're getting at is, how do you explain REIT returns from a factor perspective? And what that paper found was you can explain REIT returns by unpacking them into, or decomposing them into underlying factors. And it turns out with REITs, looking at the long history they have, which goes back to the 1970s, REIT returns are fully explained, at least the compensated portion of REIT returns, the part that comes with a return premium, is explained by exposure to market size and value in stocks and term and default in bonds. So what you can say is it's sort of a balanced portfolio of small value stocks and high yield bonds. Right? So that in and of itself, I think, caught a lot of people's attention, and they like it as sort of a simple explanation of what real estate is. And then what naturally comes out of that, well, does that also apply to private real estate? And I think it's a great follow-up question because it's a far harder one to answer. And a few years later, and what came out of some of my original thoughts on the paper you're asking about, real estate betas, the implications of asset allocation, was taking it to the next level. And a methodology I kind of created in that first paper you mentioned, real estate betas, I actually evolved to the next level with a novel econometric technique to actually attribute factor risk across private asset returns, not just private real estate, but buyout, venture capital, et cetera. And with that methodology, which we call the factor optimized lag beta methodology, we're actually able to attribute alphas and betas across private assets, deal with all of the issues private assets have in the reporting. And what we actually found was the same thing, which was pretty cool. In private real estate, you can still see that there's material exposure to market size and value, and has a kind of a high yield bond orientation. So using a different and more sophisticated methodology, we essentially found the same thing. So you can say that publicly traded REITs and private real estate largely have the same underlying exposures. The betas may be a little bit different between REITs, core real estate, and opportunistic real estate, but that mix is the same, or that set of betas are the same across real estate, which I think is kind of an interesting result.
Interesting and pretty intuitive, right? Like, why would they be different?
Yeah, no, super fascinating. So what are the implications? Like, what are the asset allocation implications, rather, of these findings?
Yeah, so just getting back to equity is a good example. Maybe I'll start there, but then I'm going to go back to fixed income. So you go across, and as you're evaluating, you're using factor models to evaluate kind of, real world portfolios, so actual, mutual funds, SMAs, et cetera. You start to realize, like I said, that the common risk factors at play in real world portfolios. First, an ICAPM market factor is a slight improvement over a CAPM market factor to empirically understand return and risk of real world portfolios. So that's cool. And that loops back to ICAPM portfolio theory and constructing portfolios based on ICAPM portfolio theory. Size and value factors, we will use them to evaluate managers, right, for performance and risk evaluation, because, like I said, they have a second order effect in terms of explaining some systematic risk. Even though you give it enough history, they aren't necessarily explaining away alphas. And so if you're looking at a manager's return over 3 or 5 year periods, a lot of the return variation there may be because of size and value exposure. And so you definitely, over those horizons, want to include factor models that have size and value in them. But over a long enough period of time, like I said, we're not necessarily seeing you're getting compensated for those in a verifiable way, above and beyond kind of your ICAPM beta adjusted return. And then getting out to other potential factors, momentum, things like that. If you're evaluating a manager, that's a momentum strategy or something that has a quality bias or, low beta anomaly, things like that. We may still use those models to understand what the manager's trying to do. But at the end of the day, when you're constructing portfolios from an asset allocation perspective, and if these are portfolios for long-term investors, which hopefully they are, then you have to step back and recognize on the equity side, the best you can say is that the only factor that has a verifiable long-term return premium associated with it in a real-world portfolio that also explains systematic risk, that is also not redundant, you have a single ICAPM market factor that takes you back to the ICAPM portfolio theory. So different applications for portfolio theory than what you might use for, evaluating a manager's track record over a 3 or 5 year period. On the fixed income side, empirically we found in our work three factors for bonds: a term factor, which you can think of as an ICAPM market factor, right? Just high grade bonds that have just maturity or duration related term risk. That risk you can do away with if you're duration matching in an ICAPM portfolio, your goal or liability profile. There is also credit risk in bond markets, right? We'll call it a default factor. It turns out, though, that the default factor is completely redundant with the market factor for equities. So it's definitely there in the bond market. It's just it's redundant. But remember what I said earlier, that one of the criterion of a genuine common risk factor is that it's not redundant with other factors. And so although we might use a default factor in a fixed income factor model, we also have to be aware that it's redundant with the market factor for equities. So as you get back to ICAPM portfolio theory, we don't want redundant factors, so we can drop the default factor off there. There's another factor there in fixed income. It's a prepayment risk factor, potentially. It has a small effect in our empirical test, but it's there. But also more recently, it's not even statistically significant anymore. So it might not even actually be there. So again, if you take these asset pricing tests and we apply them to real world portfolios, what you're left with is a term factor for fixed income and an ICAPM factor for equities or for return seeking risky assets, not just equities. And we can take those two factors together, and those are our two risk factors that we can use in asset allocation for portfolio theory, right? That term factor essentially is our liability hedging asset, and we can make it risk-free relative to the goal, which is cool. And then we have our return-seeking risky asset portfolio where the risk is defined relative to the liability hedging asset. So again, redefining the risk there. So we can take, again, this zoo of factors and boil them down to really just two that matter for asset allocation. Again, if our application is more than asset allocation, it's, manager research or, understanding the returns of a particular hedge fund or, a particular equity strategy or bond strategy, we may use more factors than that because we may have these short windows of time that we're also evaluating. But as you loop them back to portfolios for long-term investors, asset allocations for long-term investors, really all you need are those two factors, term factor and an ICAPM-based market factor.
That's pretty crazy to think about, considering all the factors that are out there, right?
Yeah, well, exactly. And what's cool here is now we're getting close to the holy grail of financial economics through the ICAPM, right? Potentially. And again, there's still more work to do, particularly in pricing assets at the security level. That work hasn't been done yet, but at least at the asset class level and the portfolio level, we have a unification of portfolio theory and asset pricing with the ICAPM, right? Where theory and empirically, we can say that assets and asset classes, or I should say portfolios of assets and asset classes and, are, essentially explained by simply two factors.
Wow.
Properly constructed.
Yeah. Well, what does that mean for, like we use dimensional funds, which tilt towards small cap and value and all that kind of stuff. What are the implications of what you just said for investors that are tilting toward those other factors?
Yeah, I mean, I think so. In all fair disclosure here, I mean, I think Dimensional is an outstanding manager when you're trying to capture, a factor-based premia, and it's an approved manager on our platform here at Northern Trust too. So I want to just step back and say, when you talk about fulfillment, there are really three approaches at the highest level, right? You can take a passive approach, where, hey, if you believe markets are, on the risky asset side, that's what we're talking about specifically here. If you believe markets are very efficient, you're going to take a very low cost passive approach. It's expense efficient, it's tax efficient. You can do a good job aligning it with your goal profile. So there's a lot of sense to do it that way, and maybe that ought to be best practice. At the other end of the spectrum, there's an active approach, right? It's going to cost you more money. It's going to be less tax efficient. We didn't really get into this, but based on all our empirical tests, we've been able to show that alpha is, they're really on the equity side. They're after expenses. There's not much evidence for alpha. Alphas are very random, and essentially the distribution of returns are well explained by some mix of factor betas. But in the middle, there's something like a factor-based approach, right? Where maybe it's semi-active or semi-passive, and so to me, those are all confidence levels. I think that if you step back, like I said for a moment there, in real-world portfolios, all you need is the ICAPM market factor to explain away all alphas, right? Now, size and value in particular still showed some return variation that explains some systematic risk. And, in tests of non-live portfolios, but, just historical returns, we certainly see return premium in things like value stocks, right? Again, those are hypothetical portfolios. And what my research tries to do is bring it to the real world with real world portfolios, because there are frictions and real world constraints on implementation. And then, there are other anomalies, what I'll call, instead of risk factors, anomalies, things like profitability and momentum. I'm not here to say that a very efficient quant manager can't pick up a return premium associated with value or momentum or profitability even, right? I'm just saying those things aren't rising to the level of a common risk factor, a genuine common risk factor that defines it the way, I think, or we think it ought to be defined by meeting those 4 criteria. Really, the way common risk factors were really originally defined, going back to the 1990s or even the CAPM, when people started thinking about trying to unify portfolio theory with asset pricing. So, again, I think what it takes is an efficient quantitative manager. You may be able to harvest these premia. Maybe these premia should be thought of as anomalies. Maybe they're there, maybe they're not. So to me, it gets the confidence levels. A genuine common risk factor meets the set of criteria that I talked about. It's far more reliable going forward. It prices assets and portfolios of assets in a systematic way. It's not to say there aren't other return anomalies out there that an efficient quant manager can't capture. I just would argue they don't rise to the level of a common risk factor that systematically explains asset returns and portfolio of asset returns that aren't sort of, genuine sources of compensated risk, so to speak.
Yeah.
So confidence levels, right? It could very well be that these anomalies might just be, they're more likely to be, a genuine common risk factor is far more likely to persist into the future than a return anomaly. But it's not to say that a return anomaly won't persist.
Yeah, makes sense. At the most extreme end of active, if I can say that, how well are hedge fund returns explained by factor models?
Yeah, I mean, hedge funds, of all the world areas we deal with, hedge funds are, understanding the return and risk of hedge funds is the most complicated, simply because, every hedge fund, or not every, but the best hedge funds are different, is what I'll say. If we look at hedge funds, on average, right, you take a look at kind of, the hedge funds, hedge funds as an asset class, like the HFRI composite or something like that is a proxy for hedge funds as an asset class. It's very simple, right? It has, essentially factors do a very good job of explaining the return and risk, whether you use a CAPM market factor or an ICAPM market factor. You will see that the average hedge fund return is nothing more than a, low beta exposure to the market factor. And that's it. All right. And so, that's why hedge funds have a 0.9 correlation to the market factor. It has a lower volatility than market return simply because it has a lower beta. So you can simply say, like, on average, a hedge fund return is like 30% equities and 70% treasury bills, because you can run a simple regression against the market factor. You'll have no alpha, and you'll have a 0.3 or so beta, which tells you that your portfolio is basically something like mostly cash and a little bit of equities. Now, why you would pay him 2 and 20 for that, I don't know. And why that's that's just redundant. You already own equities and some optimal allocation to cash in your portfolio. So there's nothing special about it. As you get into other, the main categories of hedge funds, event driven, et cetera, macro, you might need a broader set of common risk factors to get there. And prior work I did, you can even use quantitative factors. And over time, depending upon, what hedge funds are doing kind of changes through time. In the earlier history, we saw more evidence of alpha, since the tech bubble, where frankly, the data set of hedge funds is much cleaner than it used to be. There's less biases in the data set and the index returns. And so we don't really see on average or across the hedge fund categories really any alpha anymore. And even as you do manager research, and so at that level, the category level, again, you might need a broader set of factors, but still factors pretty much explain all of the compensated return and risk. There may be some unexplained risk, but it's not coming with a verifiable alpha. So it's uncompensated risk. You don't want to bear risk in your portfolio and not be compensated for it, which is why what we care about is bearing compensated risk that comes with a return premium. People like to say risk and return are related. Not all risk comes with a return premium.
Mm-hmm.
So we want compensated risk. But then, there can be a role for select hedge funds in a portfolio. It's harder and harder to find. But when we solve for exposure to compensated risks, right, common risk factors that we can otherwise easily own in the portfolio if we want, is there evidence of managers with alpha, in particular with hedge funds? If we can find strategies because they can use leverage and go long short, and they're really isolating their alpha so that it's 90% of the risk contribution and return contribution of the strategy, that's a valuable hedge fund strategy because it's kind of like a completely different asset class then, where you have a robust return premium that's the alpha that's statistically significant. It contributes like 90% of the return and risk, right? If you decompose the return and risk, decompose the returns into how much is it's driving the return and risk, how much of it is the alpha. If you can find the strategy, like that's a really interesting strategy to add to the return-seeking risky asset portfolio. It's just they're very hard to find, and I hate to say it, but as we move through time, they're fewer and fewer. And if anything, when we find them, we tend them to deteriorate rather than persist as we move through time. So I think the hedge fund space, there's still opportunity there, but you better know what you're doing, and very few people do in terms of finding those managers and strategies. And you have to be very careful, and it's less and less as we move through time. But they are there, and done right, even for taxable investors, if it's this type of strategy that really isolates its alpha, and that alpha is reliable. And I'm saying factor adjusted alpha is we add pretty every potential factor, and what's left is the alpha. Like that can be an interesting strategy, but they're very rare, hard to find. They tend to deteriorate once you hire them. So
yeah, exactly. So you kind of touched on this just now. Is there adverse selection? Like if a hedge fund is willing to take your money, is that a bad sign?
I mean, it's tough. I hate to say it. I think in the real world, if anything, markets seem to be getting more and more competitive, right? As we look at our factor models and we move through time, R squareds are going up across asset classes. Alphas seem to be random, almost regardless of what factor model you use. And in hedge funds, where we used to be able to using the techniques I described, factor-based analytics and decomposing the risk into the types of returns you might be interested in. It's just harder as you move through time. And what it is, I'm not so sure. Right? In the old days, we could kind of attribute it to bad data. We're still finding a very small handful of hedge fund strategies that are interesting. Most of them are closed or have give you sort of a limited allocation. So they're out there, but accessing them might be a big challenge for the average investor. And yeah, I think as they have opened up and gotten bigger, you're not necessarily that performance isn't necessarily persisting. But I mean, even in many cases, it's not persisting anyway. It may still be there, but in a much muted version of what it was previously. Right. So I'm just saying, eyes wide open. It's a very difficult asset class, but it's doable, and done well, it can actually improve a portfolio, even a taxable portfolio. So I don't want to throw it out completely.
So what explains the incredible? Yeah, no, fair enough. So what explains the performance of the Yale endowment?
And I haven't looked at that in 15 years. So and frankly, it would be interesting to do it again with kind of the evolving tool set we've developed over time, which is more sophisticated than what we did back then. I mean, what I can say back then is what we were able to do was largely replicate Yale's return using an element of synthetic leverage, factor attribution, and most importantly, replicating the private investment portfolio, particularly the venture capital portfolio that Yale had employed over the course of its history, at least under Swenson. And so, kind of using that technique, in a nutshell, we can largely say that Yale's, again, going back 15 years anyway, what we could say was Yale's outperformance is significantly explained by its exposure to private assets and venture capital in particular. So, give them credit for being early investors in venture in particular, and private investments, and utilizing that methodology, which was, definitely novel at the time. As everyone tried to replicate Yale using the endowment technique, the success hasn't been what it was back in the day. But in a nutshell, I think we can attribute it to venture, particularly venture when it had that run up until that point. Again, like I said today, it'd probably be interesting if I had the time and the interest to kind of utilize maybe more sophisticated techniques we've developed over the years since then to kind of revisit that question. I'm pretty sure, particularly with our ability to be able to decompose private asset classes into their underlying factor betas and the residual alphas, I think that we could probably make even more progress in understanding Yale's returns today if it became a priority for research.
Oh man,
which it's not.
I would read that paper for whatever that's worth.
Okay, it'd be interesting. I'm not sure it'd really move the needle in terms of research that gives us better solutions going forward.
Yeah, no,
I mean that's one thing
true.
I always do is like, I think like research that actually would move the needle on improving investor outcomes, right?
Right.
What kinds of outcomes, in the real world, how can we improve retirement outcomes and wealth outcomes? And kind of bridging academic research with practitioners, kind of has sort of been what I've been trying to do. And that type of research that ultimately improves those outcomes, I think would is really kind of what summarizes what I try to do anyway.
Yeah.
Improving investor outcomes.
Okay. So we talked about your research on traded portfolios. And you mentioned how, I'm just gonna ask the question. So can you talk about this in the context of jointly testing factor models and manager performance, which is what that research aimed to do?
Right. Yeah. So that's a good kind of technical question. It kind of gets to a lot of why I said what I said earlier about, which factors are at play in, which are the genuine common risk factors in real world portfolios, right? Like, because there are a number of ways to do these so-called asset pricing tests. Like, what is the best factor model? Like, question mark, right? There are lots of ways to do that. And all of these tests suffer from what's called the joint hypothesis problem, right? And this is the problem. This is the essential problem. Is any test of market efficiency, right, depends on the validity of the asset pricing model and vice versa. So then also any test of a valid asset pricing model depends on the assumption of market efficiency. So how do we overcome this so-called joint hypothesis problem that all asset pricing tests, all tests of market efficiency or asset pricing have? And the technique that we sort of innovated and used in the papers and the research that kind of got to my claim on what the genuine common risk factors are was to essentially say that we're going to basically test this world or universe of real world portfolios we're going to test both the manager returns, the manager performance, and various factor models using market efficiency as a benchmark, right? Because if markets are efficient, and we have a well-specified or good factor model, what we should see are the distribution of alphas should be random, right, in the real world, right? And so we're actually mitigating this joint hypothesis problem by simply saying that, whatever asset pricing model gives us closer to the attributes of market efficiency, i.e. random alphas, right, that is the best factor model, okay? And so we're able to jointly test factor models and manager performance using this methodology. So whichever factor model gives us this attribute. So our primary test metric was simply what's the distribution of alphas? Is there evidence based on different factor models of alpha or not? And maybe this alpha is manager skill, or maybe it's missing factors, right? If it's a missing factor, if we find alpha and we add a new factor and the alpha goes away, we know that that source of alpha was a missing factor, and then that's a genuine common risk factor. If we add a factor and the alpha doesn't go away, well, there's a problem to that factor because it's not showing up as a genuine market premium in a traded portfolio. And so that's kind of the theoretical concept that underpins kind of the technique we use to identify what the genuine common risk factors are in a portfolio. So that's where I said in a nutshell, like when we looked at the ICAPM, when we looked at equities and kind of evaluating fund returns, and we took a look at the ICAPM market factor, right? As we added other factors, the size factor, the value factor, the momentum factor, right? We did not explain away more alpha, right? We didn't see alphas being reduced as we added more factors. And in fact, what we found was that we already had random alphas by just using the ICAPM market factor. We didn't need to add any more factors to explain away alphas. So that told us right there that it was sufficient to have an ICAPM market factor to actually have the attributes of an efficient market where there was no alphas. There was no unexplained return premia, whether those return premia was missing factors or manager skill. An ICAPM market factor was sufficient to explain away all alphas. Done. We don't need to add any more alphas. Okay. Like I said, adding size and value helped explain some systematic risk. That was a secondary test statistic. Right. So that's where I might say size and value are secondary factors, but they weren't necessary to explain away alphas. Okay. But contrast that to fixed income, because I think it's a good way to think about it. We did similar tests in a similar paper evaluating bond returns, real world portfolios. Again, we started with a term factor and there was alpha everywhere. When we added a default factor, credit factor, the alpha significantly disappeared, right? So what looked like alpha with just a term factor was explained away when we added a default or credit factor. So it turned out that that alpha with just a term factor was not manager skill, rather it was missing credit risk. So already we know that the term factor by itself for fixed income is incomplete. We need a default factor to help explain away some of the alpha. It turns out also on the margin, prepayment also helped explain away alphas, which is why we have a more complete factor model in fixed income with term, default, and prepayment. However, like I said, the default factor is redundant with the CAPM or the ICAPM market factor. So at the portfolio level, we don't really need it because it's redundant with the market factor for equities. Thus, we're back to the ICAPM again. So that's the interesting thing. We want to see factors explaining away alphas in real world portfolios. If we don't need them to explain alphas, right, we're done. And so that's kind of what I mean by that joint hypothesis problem, and this notion that if we can use market efficiency as a benchmark, all we need to find is the simplest factor model that explains away all alphas, right, where alphas are just random. Because then we know that there's no unexplained return premia, no missing factors, no manager skill. We've basically achieved that ideal of an efficient market.
Really, really interesting.
Yeah. Okay, last question for you, Peter. How do you define success in your life?
That's that probably deserves its own podcast, right? Nobody will do it. Let me maybe break it into two. Like professionally, kind of like I said earlier, I guess. Professionally, the way I define success is making a difference. I hope my research makes a difference in investor outcomes, whether they are, middle class people trying to save for retirement. I truly believe the research that I've done, the ICAPM asset allocation methodology, the prevalence of compensated risk and alphas in portfolios is really, really good information that if used right, hopefully with time, there'll be more and more tools to allow investors to be able to do this. Gives them better retirement outcomes. In the world I live in wealth management, similarly, better wealth outcomes, right? You know, more efficiently optimizing assets and portfolios to fund lifetime goals so they can do more with their assets in a more efficient way that's more aligned with their goals. So to me, success professionally is making a difference in the world, adding to the body of knowledge in financial economics, and improving retirement and wealth outcomes materially relative to maybe what they otherwise would have done. I think personally, it's kind of cliche and simple, but I do really believe this. I mean, to me, success is just living a life where I'm happy and healthy. And like I said, I think that could be it's very cliche and it could be a long podcast about what elements go into that. But, you know, at the end of the day, that's all I really care about is being happy and healthy. And then maybe, you know, a little bit of that rubbing off on people, on friends and family, people I love. So, you know, maybe they can be a little happier and healthier because of it. But I think that's how I define success, both professionally and personally, in a nutshell anyway.
Great answer, Peter. And this has been a great conversation. We really appreciate you coming on the podcast.
Thanks, Ben and Mark. Lots of really great questions. You guys, you know, kudos to you guys. I think you have a great podcast, and, you know, not everyone gets this stuff. So congratulations on your success, and, you know, feel free to come back anytime. This was great.
Awesome. Thanks, Peter.